Hi everyone, and welcome back to the show. Today we're diving into a topic that's on everyone's minds: investing during a recession. Recessions can be scary, especially when you think about your investments. But knowledge is power, and understanding what a recession is and how it affects the market is the first step to protecting your money and even thriving during a downturn. Are you ready to learn how to make your money work for you, even when the economy throws a curveball? Let's go! So, what exactly is a recession? In simple terms, it's a period of economic decline. Think of it like this. When the economy catches a cold, a recession is like a bad case of the flu. We see a drop in spending, businesses might struggle, and some people might even lose their jobs. 2 consecutive quarters of negative economic growth is a common indicator of a recession. This slowdown affects everything from how much we spend at the grocery store to how companies invest in new projects. Understanding this can help us stay calm and make smart decisions when the economic winds start to shift. Okay, so we've established that recessions are like a bad cold for the economy. Governments and central banks step in with various tools to stimulate growth. They might lower interest rates to encourage borrowing and spending, or they might increase government spending on infrastructure projects to create jobs. These measures don't work overnight, but eventually, with the right treatment, the economy starts to heal, businesses start hiring again, and consumer confidence returns. Remember, recessions are temporary. The economy always bounces back. Now let's talk about how recessions affect the stock market. The stock market is like a roller coaster. It has its ups and downs. During a recession, it's normal for the market to experience a decline. This is because investors become uncertain about the future and tend to sell their stocks, driving prices down. It's important to remember that the stock market is forward-looking. Trying to time the market, or buying and selling based on short-term fluctuations, is a risky strategy that can often lead to more losses than gains. Whenever there's talk of a recession, it's easy to get caught up in the fear and panic. You might hear whispers about a stock market crash, and suddenly everyone wants to sell their investments and hide their money under the mattress. This is what's known as a panic sell, and it can be detrimental to your long-term financial health. When everyone is selling, stock prices plummet, and you might end up selling your investments at a significant loss. The stock market is cyclical, and even after a steep decline, it will eventually recover. So instead of panicking, take a deep breath and remember your long-term investing goals. Now you might be wondering, how can I protect my investments during a recession? Well, the good news is that there are steps you can take to recession-proof your portfolio. First, diversification is key. Don't put all your eggs in one basket. Instead, spread your investments across different asset classes, such as stocks, bonds, and real estate. This helps to mitigate your risk because if one asset class is performing poorly, another might be doing well. Second, consider investing in companies that provide essential goods and services. Remember, investing during a recession isn't about avoiding losses altogether. It's about managing your risk and positioning yourself for long-term growth. When the economy takes a hit, some sectors actually perform better during recessions. These sectors are considered safe havens because they often benefit from the changing economic landscape. As mentioned earlier, healthcare is a prime example. People always need medical care, regardless of the economic climate. Utilities are another sector that tends to hold up well, as people still need access to essential services like electricity and gas. Understanding which sectors have historically performed well during recessions can provide valuable insights when making investment decisions. Now, before you rush out and start making changes to your investment portfolio, I want to remind you that the information I've shared today is for educational purposes only. It's not intended to be, nor should it be taken as, financial advice. Every individual's financial situation is unique, and what might be a suitable investment for one person might not be appropriate for another. It's crucial to consult with a qualified financial advisor before making any investment decisions. That's all for today's show. I hope you found this information helpful in understanding how to navigate the choppy waters of investing during a recession. Remember, stay calm, stay focused on your long-term goals, And don't be afraid to seek professional advice when you need it. If you enjoyed this video, please give it a thumbs up and subscribe to my channel for more financial tips and advice. Thanks for watching, and remember, you deserve to be rich.